Good morning, this is another data bite. As you know, we like to provide information on things we find interesting, data we're tracking, kind of any analysis we've done that would have some impact on the Crown Capital decisions we're making, companies we're looking at, etc. And so we've had lots of requests for that information. Hopefully these data bites provide some of that and can help you make good decisions. So today we're going to talk about Elizabeth Warren's proclamation that there was a recession on the horizon. She bases that on one particular data point, household debt, which is an important item for recessions. I agree that this is something we should track, and we do track it. It's up 6.8% since 2008. So certainly that's concerning in and of itself. But when you look at the data around it, this is actually kind of a false leading indicator. So it doesn't adjust for inflation. This is a straight number, just how much household debt and how has it increased over that time period. There's no adjustment for other factors like inflation. Inflation over that same time period has risen 16.63%, right? So 16.63% inflation from 2008 till now would make this number kind of shy in comparison. If you take that off the table and say, forget inflation, just what is the debt? Well, total number of households had actually increased much more than the household debt. So interestingly, on a per capita basis, we actually have less household debt per person because households themselves have increased by more than the household debt. So there's been this decrease on a per capita basis. We've also had an adjustment in income. So in 2005, the income was, in my notes, 46,000 median income. In 2007, it was 50,000. In 2015, it was 56,000. In 2019, January this year, it is 63,000. So the median income in the households has increased substantially over that time period as well. And this shows up in our debt service payments. So in 2008, over 13% of household discretionary income or disposable income was used to satisfy debt payments. In 2019, it's less than 10% is being used to satisfy those payments. So the increase in wages, the increase in number of households, so a decrease in per capita debt, and the adjustments in inflation to account for the debt load actually indicates that our debt is better than it has been in 20 years. So our debt load is lower and we're de-levered out of these households. So I think we tend to look for recessions in patterns. And partly I think that's because we've had such a long up cycle, right, since 2008. We've had 11 years of growth. But even in 2011, this data shows that the economy was underperforming relative to its resources by $800 billion. So we were $800 billion underproductive. That could be a recession in and of itself. So this time period, we were so far underwater, it just took a long time to get back to even. So if you estimate where we were at full production and where we've grown from there, we're probably more like in a 5-year cycle right now. So it may be not as long as we think. It might not be an 11-year cycle. So the recession on the horizon, there's not a lot of indicators in the data that says it's immediate. Of course, it's hard to predict recessions, and it's hard to predict them too far out. But an immediate recession based on this data is highly unlikely. And this is all before the Federal Reserve reduced interest rates by a quarter point. So that certainly reduces this debt load service payment as well. I hope that's helpful. Have a great day.